Good morning, everyone, and welcome to our first panel, which is the 2025 Global Commodities Outlook. So what I'd like to do is just introduce myself briefly. Damian Pearson. My background is in funds management, private equity. I was at EMR Capital for many years, and I've just joined a new fund, which we're starting up, Oryx Global Partners in the Middle East. So what I'll do is I'll just ask each panelist just to introduce themselves briefly, and then we'll get started.
Good morning, everyone. I'm Scott Darling. I work for Haitong International here in Hong Kong. I'm a sell-side analyst. I've been covering energy for about 20 years. Before that, I was actually in the industry in ExxonMobil. Haitong actually, a few weeks back, became the largest bank in China. Definitely our focus is more on energy markets, particularly clean energy. We've got a very strong franchise in China, but also we're expanding internationally as well, particularly in the Middle East.
Yeah, good morning, everyone. Niv Dagan, Executive Director of Peak Asset Management. We're a boutique investment management corporate advisory business, Melbourne-based. We flew overnight, so a little bit tired, but had a few coffees. Our model is all about co-investment. So investors being funds, institutions, family offices, don't get anything from us unless we're co-investing our own capital behind. We are sector agnostic. Having said that, probably in the last 6 to 8 years, largely been commodity driven. So it's great to be here.
Warren Gilman, Chairman, CEO, and founder of Queens Road Capital. We're a TSX-listed mining investment company. Prior to that, I was a mining banker for 1 million years, and then ran Mr. Li Ka-shing's mining investments here in Hong Kong for the 10 years prior to founding Queens Road. I'm a mining engineer by background.
Good morning, everyone, and thank you for having me here. My name is Tevis, Michaud, and I'm a senior investment advisor at Canaccord Genuity Corp, based out of Vancouver, Canada. And I'm also a registered representative in the United States as well. And my team at Canaccord, we've got clients globally, all across the U.S., all across Canada, obviously being based in Vancouver, Canada. We kind of love commodities generally moving forward here, but I'm also a certified financial planner, so we do kind of the entire breadth for our clients with regards to managing conservatively, but also focusing on wealth creation as well. And some of my business partners are here as well, and we have a lot of clients and capital based here in Hong Kong, which is one of the reasons why I'm here today. So thank you for having me.
Excellent, thank you. Well, maybe just to get started, just the first question, I think what I wanted to sort of maybe Warren, just ask you your views around gold. I mean, obviously it's hit record high prices, and at this sort of levels, do you think there's still value in physical gold and gold equities more broadly?
Well, that's a great question to start off, and certainly very topical. And I must admit to having some personal bias. I grew up in a town called Timmins, Ontario, northern Canada. And my father was a lifelong exploration geologist, focused almost totally on gold his entire career. So gold is somewhat in the blood. I started working underground at the age of 16 in one of the local gold mines, laying tracks. Remember when mines actually had tracks and little railroads going? That was my first job, was laying track for those little railroads. So yeah, you could very honestly say that gold is in the blood. I started buying gold stocks when I was 14 years old, and have never stopped. Never stopped buying physical gold. My biggest haul was I used to live in Perth before I moved to Hong Kong, and the gold broker that I was running was the only gold broker that had an office in Kalgoorlie. And in Kalgoorlie, the local Aboriginal tribes would go around with their metal detectors, finding all the nuggets on the surface. And then they would go to our office in Cal and sell the nuggets to the local branch manager for a 5% discount to the gold price. And I had a standing order at the time. Whatever gold was brought into the office, I would buy at a 5% premium, give the office a small profit. So during that period, I collected a whole pile of good WA nuggets. Well, that period was 1999, 2000, 2001, and you might recall gold was $200 an ounce. So I've got a whole pile of nuggets sitting in my safety deposit box here at HSBC at 1 Queens Road, valued at sort of like Fort Knox. It's valued at $200 an ounce. And so what's that gone up 15-fold in the last 25 years? So I guess not a bad return. So I'm setting the stage to tell you that I'm biased. So what am I going to say? I'm going to say, of course, it's a good time to buy gold. I mean, this is the best time to buy gold. All sorts of reasons, all sorts of non-explanations. The fact of the matter is that, yeah, buy physical, gold equities have not performed well. Queens Road Capital, about 20% of our net asset value is in gold exposed investments. And notwithstanding the fact that the gold price has gone up 50% since we've made those investments, every single one of those stocks is lower today than it was 3 years ago when we made the investment, notwithstanding gold price. So talk about underperformance, the gold equities have underperformed. Are gold equities the place to be in preference to physical? I'm not so sure. Given the underperformance to date, one might argue that they're a loaded spring ready to go. So potentially, yes. I hope, yes. Certainly the money hasn't trickled down to the junior mid-tier market nearly as much as has benefited the seniors. So hopefully that will come good. But the short answer to your question is a good time to have exposure to physical and to equities? I would say wind is at your back. And the great thing about gold, especially when it moves, especially when it's at these early stages of moving, which I would argue were very early stages, there's literally no upper limit. You know, if Bitcoin can go to 100,000 and people are arguing it's going to 1 million, and that has no fundamental value whatsoever, pardon me if you're a Bitcoin investor, it goes there because that's what people are willing to pay. What are people willing to pay for an ounce of gold? 2 years ago, they were willing to pay 2,000. Now they're willing to pay 3,000. 2 years from now, will they be willing to pay 10,000? Of course they will. Of course they will. So there's really no upper limit to where gold could go because it's not a fundamental supply-demand argument. It's all about what people are willing to pay. And in that regard, I think there really is very little in the way of upper limits.
Thanks, Warren. And maybe just, picking up on some of those themes, what are you seeing sort of, from sort of broader investor base and appetite for gold equities? Are you seeing it strong or, are people looking at more value hunting and other ways?
It's a case of haves and have-nots. And that seems to be the way the market moves these days. If you're an Agnico Eagle, you're one of the haves, and people desperately want you at almost any price, and that is just going to keep going. If you're a Barrick, you're out of favor for many, many good reasons. If you're a Gorilla Gold that has just made a great discovery and did a financing this morning, there's tremendous demand. But if you're an explorer out there just punching holes, hoping for the next hit, it's extremely difficult to raise speculative money. That has not changed. So haves and have-nots.
Maybe, just to bring you into this, Tevis, when you look at sort of Canada and we just look at then between different markets, maybe just some comments. I mean, often you hear a view that, the Aussie is a bit depressed and then they get on a plane and land in Toronto, right? Just to what extent do you think that's true and what are you seeing between the different markets?
Well, the Canadian market has definitely been a lot quieter than the Aussie market per se over the past number of years, but I guess the Canadian market tends to lag the Australian market by about at least 6 months or so. So we're starting to see a little bit more of an uptick on the Canadian market. I think with the depressed Canadian dollar and the increase on the US dollar, the kind of the buy Canada trade is coming as well. With the price of gold being 3,000 US, which is approximately 4,300 Canadian gold price, the Canadian producers are now starting to print capital. So the right assets, and like Warren pointed out, if you're just out there strictly exploring, you haven't made a discovery, it's extremely tough. It's still very difficult to raise capital, but we're starting to see that influx is starting to change somewhat. Some of the ones that are getting some nice discoveries, the capital is there. There's been many bought deals. Canaccord is one of the
we're the largest financier, the commodity space in Canada, and our group does a lot of those financings as well. So we're starting to see more of an uptick. The right management teams are also starting to get a lot more attention with coming to the table with kind of new and better projects. So it's certainly not crazy by any means, but we've been doing this for long enough that you can almost start to get a feel and a sense for it, and it feels like it wants to start to come back. The retail investor isn't there yet. Some of the smarter money per se is starting to move. We're starting to see some of the institutional funds and some of the old boys, the old people, kind of getting more involved and writing bigger checks. So it feels like the flow is starting, but it's still early on in the sector. We're not quite there yet. And now with gold price being at all-time highs, silver's playing some catch-up. I think copper's going to be a great place to be moving forward. So with the gold producers per se, like, they're just starting to print money on their balance sheets. And as that capital starts to build up on their balance sheet, shareholders are going to look at them and say, hey, I need to do something with that capital. Then the M&A cycle is going to start to pick up. And that's when it's going to start to trickle down to the more junior stocks. And that's when we're going to really start to see the stock prices, I think, start to play catch-up with the price of bullion. Right? Because to date, as Juan pointed out, the stock prices just haven't moved yet. Right? There's been the odd darling that has done extremely well. But it's not there yet. But at Canaccord as a firm, we see the next super cycle in commodities coming, and I think it's finally kind of at the door here. But it's not there yet. It's coming. We're very optimistic moving forward, and we're starting to get a little bit more aggressive.
Thank you. Maybe we'll just turn away from gold and just have a bit of a discussion around sort of steel feed commodities. I mean, iron ore, if you take a view, has really held up very well. But over the past sort of 3 years, coal or met coal has performed very strongly. This year, you've certainly seen a bit of a turnaround at that. I think probably very linked to the outlook of steel production in China. But really, we're just, what appetite are we seeing for sort of, coal equities and more broadly, the outlook for prices? Scott, maybe. That's some of your comments.
Look, I would say in general for coal equities or broader commodities equities, I think, I've been here for over 10 years. Coal equities look good value. Energy equities look good value. And we've been talking about this for many, many years. So when I've seen coal or energy equities or commodity equities outperform the market, it's because prices have quickly increased. You can buy, if you want, Gilman or whatever you want, PetroChina, who cares? It's good value. You can point to all our charts, it's very good value. These investments have become commodity bonds. They'll give you 10% yield, 5 to 10% yield, fine. If you want that, great. Will these equities really outperform the market? And the answer is no. I completely appreciate that China should use coal. Will it? Probably not. It's trying to reduce its dependence on coal. But these equities are good value, and all they can really do is give you back the money. And you will invest that money in NVIDIA or those growth-type stocks. And we have been saying this literally ever since I've been in Hong Kong. So if your investment style is about income, then okay, fine. These guys are state-backed, especially over here. They're not going to go bust, but they're not going to give you any performance. So what I found is that investors here will still own Shenhua a little bit to get ESG stuff, or PetroChina. And the money from the dividend they will use to invest in BYD. And so that, I think, has been the sort of the investment view for many years here, not just actually in Asia, also in America. Same thing, Exxon, my former company. It's a great company, it's never going to go bust, very well managed, and give you 5% yield, I'm guessing. But you will take that yield and you will invest it in a NVIDIA or Microsoft or whatever. So I think that's the sort of investment perspective. Where do I think coal prices are going? I absolutely don't know at all. I would like to think as an environmentalist that we reduce our dependency on coal, but I've got to be honest, if I'm an Indonesian person. Yes, I want to develop coal. It's the cheapest form of resource in that country, or China. So I think it's interesting. When I joined Exxon, Lee Raymond, the chairman and CEO, didn't even believe in climate change at all. He believed in the lowest cost for commodities. And I think now, after COVID, we've always wanted to go renewables or whatever. But in actual fact, what do we want as a consumer? We want actually the lowest form of energy. Now, if it's coal and it pollutes things, okay, I'm sorry. So I think that's how I think some countries are realizing that because it's affecting their policy. I mean, Canada, I would argue, should go back to fossil fuels, should forget renewables, etc. I think, different countries have got to sort out their energy transition how they want.
I don't know if there's any other comments on that from the panel. I mean, I think it's, just picking up on that, comments around Exxon. Obviously, BG announced this BP announced this week that they were going to basically retreat to the traditional oil business. You've obviously got a very pro-fossil fuels government in Trump. And, you're seeing a number of lenders, actually retreat from the net zero banking advice. And I guess, is that, you sort of look at that, do you think that's going to accelerate coal prices or, interest in, more coal and oil related equities?
I think the whole energy transition is an interesting one. I mean, what we are seeing in the US, especially Trump's putting a lot of pressure on a lot of the whole E and S and G and climate and Paris and the Accords, and we are seeing going back to the traditional fossil fuels and drill. So what you're saying as well is absolutely correct, that we are seeing the consumer at the forefront here, and they're dictating the pricing at the moment. What George was saying as well, I mean, I spent 2 years in Canada and found that the Canadian market is essentially 6 months backward looking. So where you do see that, an appreciation and revaluation relative to the ASX. But we are seeing, going back as a whole, more money coming into the explorers, which is interesting. So for the first time, I'm saying down under, we are seeing a lot of consolidation, whether it is in coal or oil and gas or gold. I mean, especially gold with, price hovering around 5,000 Aussie per ounce. But overall, going back to the energy transition, it comes down to the consumer, and the investors want to make money and get the cheapest, rather than the cleanest. And that's how the market has definitely shifted in the last probably 6 months.
Let me throw my 5 cents into this, Damian. I'm a long-standing bear on anything that's sort of energy related. But in the near term, look at supply, look at demand. Supply, we got OPEC just desperate to keep increasing supply, looking for an opportunity, looking for a window. You've got Trump encouraging OPEC to open up the spigot and provide supply. You've got domestic concerns in the U.S., drill, baby, drill, as you said. So we're going to have increased natural gas supply. We're going to have increased oil supply from onshore U.S., perhaps even offshore U.S. going forward. We have growing détente, shall we say, with Russia. If Russia trade reopens again, we've got massive supply. So from OPEC, from US, from Russia, from all 3 major suppliers, you've got huge pressure to increase production. Demand, it all comes down to China. We've got China demand, next to zero growth. We've got global growth in terms of potential European and U.S. recession. We're now building in 2 rate cuts in the U.S., and we've got growing bets on a recession in the U.S. So mitigating demand, massive impetus for supply. How can you be a bull in that market? Just don't touch it.
I'll just jump in here. I think you can be a bull if you think that interest rates are going lower and monetary policy will reduce, and essentially another wave of quantitative easing.
But rates are falling because we're potentially going into a recession.
Yeah, but I mean, Trump wants to potentially restructure the debt at the lowest point and become a hero. So he's definitely got an end game, we feel. And
that end game is lower prices for the American consumer. He realizes that the one card he can play, lower energy prices in the U.S., don't care how we get there, don't care if it costs the Saudis, don't care if it costs Exxon, but if it's cheaper gas at the pump, I'll get more votes, I'll get more popularity. That's not a recipe for higher prices.
And how do you think tariffs play into that, though?
Tariffs are a tax on the American people. All of these costs get passed on to the American consumer. They will pay the price. It's a way for him to lower corporate taxes and increase personal taxes without increasing taxes. It's a money grab from the American population, not from the world population. The world doesn't pay for American tariffs, Americans pay for it.
How does that benefit the US consumer?
Not well. Hence the recession goal.
Hence, the bullish outlook for gold.
Right.
I mean, maybe just staying on the themes of sort of Trump. I mean, what's very interesting, I think, if you look at, his recent announcements around looking for security of critical minerals, looking at promoting mining in the US, looking at essentially trying to shorten permitting timelines. You kind of look at the dispute with Canada. I mean, is this the sort of where does this end? Is it the end of friendshoring? Is it really credible to think that a minerals value chain can be built in the US? Or maybe I'll ask you just to start there.
No. No, it's all pretty humorous. But at the end of the day, unless you have long-term offtakes with government guarantees, what private money is going to invest in uneconomic mineral developments in the U.S.? If it's economic and should be built, and then the only thing holding up the development of that project was permitting. If we can increase the pace of permitting, that's great. But there is simply not going to be uneconomic onshoring without U.S. government offtakes. Look at uranium, for example. I mean, effectively there is zero. The lights in New York City, Chicago, L.A. stay on because of Russian uranium, Russian enrichment, Russian conversion. Talk about a security risk. That's how the lights stay on. And yet, the U.S. refuses to give commercial guarantees to incentivize enrichment in the U.S. Therefore, enrichment will not occur. Therefore, for the foreseeable 20, 30 years, we'll continue to be reliant on Russian enrichment. The U.S. government does not take it to the commercial level, whereby, yes, we will pay you and we will pay you higher prices. Will the U.S. pay you a higher price for copper that's produced in the U.S. versus copper that's produced in Australia? No. Will they pay you a higher price for rare earths produced in California versus the rare earths that are produced in China? No, they never have. They've been doing this for 40 years. They've never paid more for domestic production. And even under the Trump administration, they're not saying they're going to pay you more. So will it happen? No.
So really there is, the global cost curve is just going to play out here, which, really says that it's going to be very hard to shift, a lot of the critical minerals production and processing away from Asia. That's the piece. Is there any alternative views there? And what is the interest from investors in that sort of critical minerals? And let's look at lithium particularly, which obviously with hydroxide prices, below 10,000 tonnes, is literally, a space which is pretty tough at the moment. Is there investor interest around that? Maybe I'll just start with that.
Well, I think it's right now from our standpoint in Canada, there was obviously a crazy lithium boom, right? And as most things get overbought, overstretched, that period of time, I went down to the Sigma lithium mine down in Brazil and went and checked out the operations and went and kind of looked at these things. It was a couple of years ago, and during that period of time, we kind of went down there and actually looked at the operations, checked out some other nice discoveries and whatnot, and we kind of came away from that saying, sell lithium, buy uranium. And then there was a good uranium trade at the time, right? So these things are they fluctuate, right? They kind of there's trends and ebbs and flows, right? So on the lithium side, there's not a lot of interest right now, especially on the capital market side. I'm just focusing more on Canada, but we actually just looked at a lithium deal that came across our desk just last week, and it was because of the players that were involved, the size, the scale, the cost of production, etc. It's not something that's in hard rock in Canada that's never going to actually turn into a mine. So we're looking at it kind of longer term because we do see some value that asset class is not going to disappear, right? So there are some flashes in the pan per se, right? And quite frankly, I think there's opportunities in critical minerals right now. That's a kind of a hot term. Just like kind of AI might be a hot term, but it's those are things that you kind of need to look at. We like our business. We benefit when our clients benefit. So we have to have a long-term time horizon for our conservative capital management. But when we're looking for wealth creation, that's where you want to look at these trends that are emerging. Right. So right now, are we actively buying lithium or getting involved in that segment per se right now? The answer is no. But are we starting to look at the segment again because we think it's coming back? Short answer, yes, but it's not happening overnight, right? And things with politically and kind of the U.S. kind of buy U.S. Are they going to be able to change their fleet? Everything in 4 years? Probably not, right? It's just not going to happen, right? This isn't a political game, right? But from my standpoint, Trump. Everything that he's done, commodity prices are starting to go for a run. So selfishly, that's good for some of our clients and some of our issuers. So we have to look at the opportunity. We're starting to see a lot more deal flow. Like there's been a few coal deals that have come across Canada's platform that I haven't seen a coal deal in 15 years, right? So some of these things are starting to, they're worth looking at because we think that we can make money for our clients, right? But it's a lithium. Yeah, we're actively looking at it right now, but we're not ready to jump in again. We had a good run on that a few years back. I was a buyer of lithium per se. I'm not talking equities for the last couple of years, but we're definitely keeping our eye on it. There's been one of our investment banking clients out of Toronto just came to us with a pretty interesting lithium deal that we're looking at right now. That we haven't seriously considered everything in that space for 2 years, but now we're looking at it again. So, but that again, that's more of kind of a longer term trend, and we kind of see coming back over the next couple of years potentially. But again, I'm looking at kind of the deal flow that comes through Canaccord. We see hundreds of deals every single day. And so that's where we can kind of start to look at the barometer on what might be in favor versus what might not be. You can see what's getting financed, what's a bought deal, what's getting oversubscribed, and that's where you can kind of start to get a little bit of barometer of what sector might be in favor for your clients over the next 12 months, that type of thing.
Yeah, no, look, some good points. When I was in Canada, it was all about cannabis, right? I still remember seeing a few, farmers turning into and creating literally cannabis farms and selling it and IPOing, literally, going from lettuce to cannabis, right? Things always go in cycles. And look, lithium, what was fun about lithium is that the retail investors absolutely love lithium. And still remember here where you had Jody DeRouge, who just was a prospector and just going out and literally staking thousands of acreages in Canada, in Quebec, in the James Bay region, and selling it to the Aussies, right, for a crazy premium. So look, when it's good, it's good, but everything has a bust and everything moves in cycles. And right now it's all about gold. We're seeing the inflows is in gold and copper, antimony, gallium, a little bit of those side metals, but we'd love to see lithium coming back in because that brings a lot of interest from the retail investors, which creates liquidity.
Just a few comments I would say on lithium. And I would say one of the biggest mistakes I've made as an analyst here is actually backing lithium stocks. And I think one of the reasons is I don't think any of us in this room really know the cycle. Lithium as a commodity hasn't been around that long, actually, relative to, say, oil, which is my background. So I don't really know lithium cycles, and I don't believe many people here or in the world know lithium cycles. So we had a bull market in 2022, great, really well. And I guess my mistake is in the oil world, supply quickly does respond to demand. I think in the lithium market, you've got a load of big players who just always tell me they're the lowest cost producers, whether it's Australia, Chile, who cares? You could say the same thing in oil, but that cycle responds a lot quicker than lithium does. I actually think now, after my mistake, which nearly got me fired actually, you're probably going to get consolidation simply for to reduce your costs. I mean, I used to cover this Levant or Arcadium lithium. I'm very surprised, like Exxon is getting into lithium. Why? Because they relate to lithium because they mine in Canada. So the engineering is sort of similar. That's why they're getting into lithium. So in actual fact, while the lithium sector in terms of equities has been a dog for I don't know how many years, right? And no analyst will say, hey, I think lithium prices are going up. Ironically, I think lithium equities might actually do well simply through M&A and consolidation.
And I think the issue with lithium is the integration as well of the supply chain, which I think gets sort of missed a little bit as well. So the lights will stay on despite being underwater, but significantly by TSO. Yeah, so that's the addition charge. And maybe just moving away from sort of lithium and thinking about the broader sort of battery materials space. I mean, lithium is probably the biggest way to play it, but is there other opportunities around there? Graphite has had a very sort of difficult time recently, and arguably there's technological risk around it. Do you think there's other? What's the outlook for the other battery materials? And is there investor interest there? Maybe I'll start with you.
Yeah, look, I mean, I think in terms of battery materials, you're looking at graphite, you're looking at nickel, you're looking at the antimonies, the galliums of the world. But going back to graphite, it's been very hard. And you see a really strong correlation between the price of graphite relative to lithium as well. So in terms of when you look at the lithium-ion battery, there's more graphite and copper, let's say, relative to lithium, so as a percentage. So I think we do need supply disruptions coming through. It's interesting, we backed a company going several years ago called Volt Resources, and they've got the third largest resource in the world in Tanzania, and that's absolutely struggling at the moment. Having said that, they are working on the downstream business in the US, and they've got a processing facility in Ukraine, which is interesting. So they were trying to capture the whole end-to-end side for graphite, and in the process of hopefully picking up an $8 million US grant. But yeah, look, graphite's still tricky. I spoke to another CEO last week, Metals Australia. They're drilling in there in Quebec, actually, in Canada. At the moment, they're seeing a lot of investor interest coming through in terms of their. I mean, it comes down to exploration resource, but I think it's just going to take time. I mean, you need to see us more consolidation, more M&A, and you've seen, and also the high cost producers are going to find it very, very difficult to raise sufficient capital in the market.
Warren, any comment on the broader battery material space?
I've got a rule of thumb: whenever you see one of these monikers, battery materials, critical minerals, just run in the opposite direction as fast as you possibly can. Now, why are we all of a sudden renaming metals? Each individual metal is different. Each one has its own supply-demand fundamentals, and you need to judge each one on its own merits. Name me a metal that isn't critical. It's hard to find one that is replaceable easily and economically. They're all critical. So why all of a sudden we're using this term critical minerals? Just look at each individual metal. I was never a believer in the whole battery metal concept. I mean, nickel was never a battery metal. It never will be a battery metal. Nickel is used in stainless steel. That's what sets the price. So whatever the demand is for nickel in batteries going forward is going to be a price taker, and it's a rounding error. So don't get caught up in the whole let's reclassify metals according to new marginal demands. There are metals that from a pure supply demand, looking at all demand, not just the latest, sexiest change in demand, all demand, there are those that are in fundamentally oversupply and those that are fundamentally in undersupply. And it takes a long time for that fundamental picture to change. Nickel, the world has changed. Nickel is dead. If you've got a nickel project here, unless you're going to be in the top decile of production on the cost curve, find another project to work on because it has no future. Lithium, I'm afraid, I view as zero future. We should put the final nail in the coffin of lithium. We got WA producers that are trying to expand their way into profitability. We're losing so much money on this level of production, but hey, we can get economies of scale if only we expand. We got African producers that are trying to expand their way to profitability. We got the US now encouraging, not now, but for the last several years, encouraging production of onshore lithium. So Ioneer is going to develop their mine. Thacker Pass is going to get developed. The world does not need one more lithium mine. It needs to close a bunch of lithium mines. But those mines, they're massive, and they are going to get built onshore in the US. Is that going to help the lithium price? No, it's not. Let's put the final nail in the coffin of lithium developers and say, guys, just stop. Stop. The world doesn't need any more of this stuff. Let's move on. And let's never utter the word battery materials ever again.
I think that's right. I mean, you see a lot of this, right? I mean, manganese is probably the other one as well, which is sort of thrown in there, right? And the margin in demand, as MP batteries is limited. Maybe just sort of a slightly different type, which can obviously create supply-demand imbalances, is just some of the restrictions which China's placed on the export of metals. And I mean, personally, I always find it tough to invest on the basis of potential government action, because that can be removed pretty quickly. But maybe just start. Do you think any of those restrictions which China's announced could actually create investment opportunities?
I mean, despite what Warren said, I think if you're a rare earth producer in California, like MP Materials, I actually think this is a benefit. Bear in mind, China has still kept NdPr oxide 25% tariffs on foreign imports of that product. So we've already got the tariffs, so I don't think anything's going to change for that business. So, and Linus is the same, and both of those companies have been diversifying away from China anyway. MP Materials as an equity hasn't done very well, simply because the market doesn't sort of believe it's going to really ramp up its phase 2 and then phase 3 production. But would I want to be in their shoes? Absolutely. I think it's a great business. So if you're an American producer of commodities, I think tariffs will be a benefit. Maybe not to the global trade or whatever, but as long as we keep the Inflation Reduction Act and I was coming here, I haven't seen anything that Trump has said of redacting some of that act. So if I'm a solar producer or I'm a producer of lithium or whatever in America, I still think I get his production tax credits at the moment. I do agree with some of what Trump has said in terms of, I don't want electric vehicles, I want to support all electric vehicles in America or things like that, but I definitely want to support economic, low-cost energy. If that's solar in California, bring it on. If it's natural gas, I still can't understand why the world doesn't embrace natural gas a bit more. We go straight to this, crazy green hydrogen or whatever. That is a commodity which has done extremely well, and it's in abundance, and we can manage the carbon footprint. I think that's where the American energy industry is coming from, that we're still going to pollute, but by the way, we'll take your CO2 and we'll dump it in the ground or put it into space or wherever.
Thank you. Oh, yeah. We've got about some 10 minutes to go. I mean, maybe at this point we'll just see if there's any questions from the audience.
Part of the gold price action, is there any technical aspects that you can allude to in terms of all the gold that's being moved from UK to the US? Whether that, while it may not have affected, could have affected the spot price, because a lot of the derivatives which run out of London haven't had the physical holdings in London to support them. Is there any insights into that at all?
My view on all these things, and our keynote speaker made a mention of the move in copper prices, again, tariff generated. Those are short-term aberrations. Sure, we had gold move to the U.S., we had copper move to the U.S. So we've got Chicago prices higher than London prices, and we've got potential shortages in London. That's a one-time move. It means we've got a split in pricing in the short term. But in the future, will there be flow back? It depends on the tariffs. If there isn't flow back, it means we've already satisfied demand for copper and gold in those markets for the next how many weeks, how many months, which means lower demand. So ultimately, those prices are going to come back down. These are short-term aberrations that are done by, tariff moves, and I think it clouds the overall impact of what we want to see, which is long-term global change in pricing. That's mine.
Any other questions?
I'll leave Canada out of the calculus. Wake up tomorrow in Greenland and Ukraine are now part of America. What next?
I don't think Ukraine's going to be part of America. I think Ukraine is, the writing is on the wall for Ukraine. The question is, does the writing on the wall for the Baltic states and Serbia, Romania, and all the eastern states? That is a question that Mr. Trump, I think, will have to deal with in short order. And I don't see necessarily a change in Greenland either. Any of those things going to have an impact on change in metal prices or commodity prices? I think the biggest change is if we have peace in the Ukraine, do we have a further détente with Russia, which brings all of those commodities back onto the world stage in terms of supply, and that could be significant for energy prices, maybe in the short term for uranium prices. That's the near term risk, I would say.
Yeah, there's certainly been a lot of restrictions. Obviously, your point regarding supply is interesting because we don't feel that Greenland will be taken over in Ukraine. I think it's just a political stunt, essentially. But
Yeah, look, it comes down to demand and supply, and if you do see Russia come into play, then I agree with you, Warren. I mean, uranium prices and oil and gas prices, you're going to see more supply that drives high. So that's something that we're looking at.
Any other questions? Okay. Well, look, I'd just like to thank everybody for their time today, and we'll wrap up here. Thank you.
Yeah, thank you.